Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. I think I've got an interesting topic to talk about tomorrow, which is my ideas around tax reform. Probably a complete waste of time given the government is probably unlikely to consider any of them, given that they're probably more interested in votes than actual meaningful tax reform. But anyway, I thought it'd be interesting to talk about it and kind of add to the conversation. Anyway, that's for tomorrow. Let's get into some listener questions. And the first question is from Jeff. Jeff writes, "My name is Jeff. I've been an avid listener of your podcast for some time. I really appreciate the practical insights and down-to-earth advice that you share on investment strategies. They've been incredibly helpful for my journey towards building wealth. Thank you so much for the value program." Thanks heaps, Jeff, and thanks to all the Jeffs out there that express their appreciation. In one of your episodes, you mentioned that when borrowing from a non-deposit taking institution using property as equity, any funds placed in a linked offset account may not be secure if the lender was to go under. That point really stood out to me. This caught my attention because I currently have loans with Resimac, and I've been putting money in the offset account for that loan. I followed up on the topic with ChatGPT, and it suggested that the offset funds are not held by Resimac directly, but rather a separate bank account. I looked up the BSB and found out it was Westpac, and that the offset account is under my name. According to that, the funds would remain safe in the event of Resimac were to enter into administration. We're considering placing more funds in the offset, but wanted to ensure the safety of those funds before proceeding. I greatly appreciate your perspective on this, given your experience in the field. It's a really good point, Jeff, and perhaps one that I should have elaborated on when I made that observation. Resimac's a pretty big mortgage manager, so it's got the infrastructure to deal with transactional accounts. In fact, it has to offer a fully functioned transactional account. It's really ultra small lenders, and particularly there's a couple in the self-managed super fund loan sphere that don't have that. But if you're with Westpac, then Westpac is an ADI, approved deposit institution. It will get the $250,000 government guarantee if it was to go under. But if Westpac went under, we've probably got bigger problems. So I think your money is safe, but it's a bit of a lesson for everyone. It's a great question, Jeff, in terms of outlining the approach that you took. I think you're bang on using ChatGPT or Perplexity or one of those AI functions to learn a little bit more about the structure of your products and then sort of trace through, how they're held and how they work is really valuable. Okay, next question is from Alex. Alex writes, "Love your podcast and book. I have a general question regarding super. I'm in 2 investment options in my industry super fund. I've done that to reduce fees via a index high growth option, which is 75% of Alex's balance is in that, and maintain a small exposure to infrastructure and private equity through the balanced option, I guess premix balanced option. 25% is in that. I recently, post-Liberation Day, contemplated rebalancing my investment option allocations, but never did as I was worried about some of the unintended consequences. If you could go through the pros and cons of rebalancing investment options within super, I'd really greatly appreciate it." So Alex, that is really an excellent question. And I've talked about this a little bit in the podcast, episode 356 in May. The heading was how to choose a investment option within super. And last year, episode 310, I talked about or challenged the idea that we should invest all our super into the share market. I think the answer really depends on your age, mostly Alex. But assuming you're more than 5 to 7 years away from retirement or wanting to access super, and certainly if it's more than 10 years, I believe that you should stick with the investment option that you chose before Liberation Day for most of your life. Chopping and changing investment options is really the easiest way to mess up performance, because performance comes from the waiting rather than the doing, and tinkering with asset allocation, all these sorts of things just creates problems. Remember, the fund is already dealing with those asset allocation decisions, so the fund isn't blind to the implications of Liberation Day and how much allocation we have towards the US and how is that invested in the US and how we sort of navigating some of those risks. The fund is already considering, they should be, and I'm sure they would be, considering all those factors. So let them do their job because that's what you're paying them to do. You're paying that investment fee for really their asset allocation decisions. So let them do their job and keep your hands off it. If you are concerned about it, then just stop looking at it. I mean, that's a bit facetious really, but I mean, really ultimately that's the best thing. So, I mean, I think it's about understanding performance and volatility and understanding that, yes, if I have a higher allocation to growth, I'm likely to have higher volatility, which means that my returns can range anywhere between -10 and +40 in any one given year. That's a reasonable expectation in terms of returns. It's a wide range, hence the volatility. And every 7-ish years, I'm going to have a big event. So the market's going to drop 10, 20, 30%. But over decade-long periods of time, that's what's going to maximize my balance. Now, if you're approaching retirement, then arguably capital preservation starts to become more than investment returns. Maybe, I say arguably, because of course that's when I want to start drawing super. But if I'm entering into retirement, hopefully I've got many decades left of very healthy and enjoyable retirement. So we don't want to be underinvested too early as well. But that would be the only situation where I'd start thinking, okay, do we want to carve off some risk here just because you're at a different stage of life, not because what's going on in markets. But I think it's a point that perhaps I haven't made well enough previously, that an investment manager's job is to navigate the known and the foreseeable risks that are in the market. So you don't need to do that. You don't need to change the asset allocation. They're already doing it. And a good investment manager is probably going to only change at the margins rather than make any very aggressive or wholesale changes. But thanks, Alex. It is a really good question. Okay, next question is Pierre, and I'm going to summarize the question, otherwise it's a little bit too long to read out. I answered Pierre's question in episode 355. Apparently, I think I remember the question, and it was really about setting a investment property budget and trying to not compromise on the quality, or really better way to put it is get the highest quality asset. And I suggested to Pierre at the time that perhaps they were better off, he and his partner were better off actually taking money out of offset to reduce their actual home loan and perhaps selling some shares to reduce their home loan in order to free up more borrowing capacity on the investment side. And this is Pierre's situation. He was kind of in the villa unit sphere. But if he did that, he would extend his borrowing capacity from about $1 million to $1.4 million, which would allow him then to buy a house. And so, just by playing with some of these numbers, that's really the outcome. And I guess it shows the intersection between mortgage advice, just plain vanilla mortgage advice, and mortgage advice that's really focused on achieving the best outcome. And in our business, I try and talk as much as possible to our team about trying to find avenues to add value. In this conversation, actually, Pierre's been working with Mario, which is one of our mortgage brokers. So we're obviously pulling apart these things or identifying these things. I think it's a really valuable thing. It's not initially, at the beginning, people might not see the value, but Pierre will make a better decision as a result. And in 20 years' time, he'll look back and go, well, okay, that analysis and work that we did around setting a property budget was really valuable. And by the way, episode 360, I talked about the factors of setting a property budget, very important aspect. Anyway, Pierre's got some follow-up questions in regards to my answer. The first question is, given that share markets have historically outperformed the property market and offer greater liquidity options, does it make sense that most, if not all, our wealth is invested in property versus shares? Considering our investment time horizon is more than 25 years, volatility doesn't really matter. Returns will smooth out in the long run. And would a better mixture of property versus shares be more appropriate? Now, one of Pierre's observations he makes earlier is that if he does what we've suggested, he'll be very heavy into property. Firstly, let's address some of the issues here. Share market versus property market. Broadly, they're about 10% in the long run. If you look at the Aussie market over the last 45 years, if you look at international markets over 45 years, now they've performed differently at different times. So if you have a look at the Aussie market over the last 10 years versus international, Aussie's underperformed significantly. I did a blog about that recently. But if you look over very long periods of time, very similar. The mixture of income and growth is different, both in Aussie and international share markets. but the total return is the same. Same with property. If you think about it, if you look at the average median rental yield, I mean, in the early 80s, it was very high, and then it's sort of stabilized since. But you could draw around 3% in terms of rental yield, and then growth average about 7%. So again, 10% total return. I think broadly, I don't get drawn into the conversation around which is better from a returns perspective. I think they both can be good. One of the benefits is that I think it's in the share market, the general methodology, particularly in developed markets, is you can't pick a winner. It's too hard. The professionals can't do it. And so instead of picking the needle in the haystack, buy the haystack, which is the index. But the methodology is the reverse in property. In property, the value drivers are static and factual. They're not a case of my opinion. The land size, land location, supply, demand, location, or proximity towards amenities, all those sorts of things are a question of fact. And they're static. They don't change. They sometimes take many decades to change, but they tend to not change. And so for that reason, you should be able to outperform the market, if you like, which however you want to measure that, median house price, whatever it might be. And that's an important distinction too here, because if we're going to put all our eggs in one basket, how confident are we that the assets that we buy are going to actually achieve the returns that we want? Well, with property, if you apply fundamentals and evidence-based approach, get good quality advice from someone that's got decades of experience in that local market. There's no guarantees, but you can, to my mind, reduce the risk significantly to give yourself high level of confidence that it's going to work out. The other thing is, as Pierre said, he's got a long time horizon, 25 years. Typically, if you look at the life cycle of investor, and I've done a podcast about this as well, is in the earlier years, say in the certainly 20s, even through the 30s, it's not unusual for someone to be property heavy. What I mean by that is that most of their investment assets are in the property market, including the home. And then gradually, as you get older in your 40s and 50s, you can start to introduce more diversification. But that's okay, because we want to inject that property into the mix as soon as possible, because we want to benefit from that compounding capital growth. We want that property 7.2% growth, doubles every year. So the dollar value of growth that we're getting in 30 years' time is significant. And so you need to get in early to do that. And so what you want to do is have more balance by the time you get to retirement, but don't worry so much about your asset allocation on the road to get there. Want assets that are going to provide most of the return in capital growth rather than income, and assets that you can safely gear to, borrow to buy. And of course, that's property. The next question is that Adam's asked, what do you think the advantages and risks of allocating 1.4 million into property versus shares? Well, firstly, that's not a fair comparison, because with property, you can borrow to higher LVRs and you don't have any margin call risk. Whereas with shares, borrowing against shares and gearing a share portfolio, you've got the margin call risk that you need to navigate. Then you've got to think about interest rate differential. I think there are some sort of competitive margin loans out there, but most of them are more expensive than investment mortgages. But putting that aside, I think the key thing here is, would I put, even if it was ungeared money, if it was my own money, would I put $1.4 million into the Melbourne property market, or would I put $1.4 million into the share market right now? Well, with the backdrop of share markets being at all-time highs, all asset classes are running, like I spoke about last week. I just don't think I just wouldn't do it. I'm telling you, I wouldn't put $1.4 million of my own money in the share market. And in fact, last week's blog was about keeping your powder dry and, keep reserving some investment capacity for better times or more attractive times, which is not suggesting stop regular investing. I'm still regular investing, as I said last week, but certainly not to my full extent. And I'm quite happy to do that. Whereas the Melbourne property market's a completely different proposition. You've had no real growth for 10 years. Relative value is, it's obvious there. And the fundamentals are still really sound. The taxation regime, as Campbell will talk about, in fact, at the beginning of next month, isn't that much different to other states in terms of what's been going on in Victoria. That's being overplayed. And the fundamentals, population growth in real terms, both in percentage, it's very strong, but in real terms, it's the strongest. So, the fundamentals are there. I think they're completely two different options, one that I would not do at all, and one that I'd be very excited about pursuing. But here's the thing, right? If you attack these problems trying to compare these two options, you'll end up going round in circles. What you need to do is take a fundamental approach. And this is why I wrote the Investopoly book, right? You've got to ask yourself, Pierre is 25 years away from retirement. The goal is first to build your asset base, your net worth, and then tilt towards income or have more liquidity and so forth. What is the best investment that's going to allow Pierre to accumulate as much wealth, net wealth, over the next 25 years? Simple. It's borrowing to invest and investing in assets that provide most of their return in capital growth. And it's gearing into property. Then the next question is then which market presents the best opportunities over the 25 years, but even also in the shorter term, just to mitigate risk. And so I think that's what you need to do. If you're just going to start comparing property and shares and things like tax implications, interest rates, borrowing capacity, repayments, all those sorts of things, you won't get any closer to the answer. And the last question Pierre asks is, what structure should I invest in if it's shares? The answer is not shares, Pierre. Look, I think it's wrong to say you're overthinking it. You're not overthinking it because I think that's a bit of a silly thing, but you're approaching this investment decision in the wrong way. And this is not a criticism of you because a lot of people do it. And that's why I wrote the Investopoly book. You've got to go back to first principles. You've got to go back to basic math and basic principles. If you're going to end up, first you've got to develop the strategy and then the tactics underpin the strategy. The tactics are, do I invest in shares? Do I invest in property? The strategy should come first, right? Otherwise, you'll end up being distracted by shiny objects. You'll end up, thinking about different opportunities and you'll end up making the wrong decision. But hopefully, Pierre, that gives a little bit of commentary around the answer that I previously gave you and setting that budget, getting into a house, out of that villa unit into a house budget, I think it's a no-brainer for me. I think in 20 years' time, you'll look back and go, well, that was a good decision. Okay, next question is an interesting one from Graham and Helen. Graham and Helen retired. Actually, Helen's just retired. And I'll just give you a bit of a brief summary. They've got their own home, no debt. They've got investment property, no debt, worth about $900,000, generates about $22,000 a year. Graham has 1.75 million super. Helen has 1.26 million super. They also get some UK pensions, so some additional income that's indexed for life. And then they've got 180 in a colonial fund and 270 in an MLC fund. And 130 grand in a term deposit. And essentially, Graham and Helen's questions are, what should I do with the property? It's in Brisbane. And what about putting the money into super from Colonial and MLC, knowing that you've got to be a bit careful because Graham's pretty close to the cap, but Helen's transfer balance cap is about 2 million. So she's got about a 750 kind of headroom in there to get those monies in. So the first thing with Graham, whilst we're on the case, with non-concessional contributions, you're not allowed to make any non-concessional contributions when your balance is more than $2 million. Graham's 250 away from that, should be okay. He should have a couple of years because Graham's saying, so I'm just thinking out loud here, Graham's saying we'll sell down the Colonial Fund over a couple of years just to spread out the capital gains tax and make concessional or personal concessional contributions to offset some of that CGT liability, which makes sense. And Graham should be able to do that and get that money inside super. And even if, not all of it can go into pension phase, that's not a big deal. You'd still get the money into super. And well, actually, it'd only take Graham up to 1.9 because there's no real benefit because Helen's got plenty of cap left. So actually, Graham, if you're 175 at the moment, I only put 150 into your super, which I think is what you're saying net of capital gains tax. And then you've got the 270 MLC portfolio where you can certainly put that all into Helen's super, potentially using the carried forward concessional contributions and you might want to do that over a few years, use the personal contributions to offset the capital gains tax liability. But Graham's asked me, what would you do with any leftover money? Look, I would put all the money into super, probably even put the $130,000 sort of safety money that you've got that's in a term deposit. I'd probably put that into super as well. Essentially, Helen and Graham can have, in terms of their caps, they can have combined $3.9 million in super. So if they've got any assets anywhere that's less than $3.9 million, it should be all in super. That's got to be the goal. Certainly once you're retired, there's no problem with putting money in super. It's not locked away. You can redraw it in a lump sum or in increments or whatever. You've got complete control over it. But obviously the benefit is it's a zero tax environment, which is better than outside. Now, if you had a little bit of money outside of super, let's say $50,000 that's invested and you've got no other taxable income, you're not going to pay any tax anyway. So it's not absolute, but just as a general approach, yeah, I would get all that money into super, both the MLC and the colonial and the term deposit, just because why would you pay tax outside of super? Now, in regards to the investment property, Graham said, look, I would think about selling it maybe in 3 years' time. Maybe there's a little bit more growth in the Brisbane market. Look, I think in the short term, sentiment always drives market. In the long run, it's fundamentals. Now, there's a lot of positive sentiment around the Olympics in Brisbane, which is 2032. Of course, it's well documented that Brisbane's been investing a lot in infrastructure. I mean, that's been needed anyway. Some of that infrastructure has been necessary, but essentially an Olympics really brings forward a lot of infrastructure spend as well. But apart from the timing of the implementation of that infrastructure, it doesn't really change the fundamentals, to my mind, of a property market longer term. But there's sentiment you can't ignore. There's positive sentiment around the Olympics, and I think that will continue through to 2032. And then what I think will happen after 2032 is that property prices won't do a whole lot in Brisbane because they would have had, by then, a significant growth cycle. And maybe it's possible that property prices have got ahead of themselves. So if I own that property, knowing, Graham, that you're going to probably maximize your caps by getting all your other money into super, if I own that property and if I thought it was going to perform in line with the market or above, then I wouldn't be rushing to selling it unless there was some significant reasons to do so, like a massive capital costs or, in terms, property always needs some sort of maintenance, but even then I probably wouldn't be that interested in doing it. But look, I think that's what the market holds for Brisbane. Interestingly, over the last 6 months, annualised growth has been the best in Brisbane than any of the other major 5 capital cities. So, there's still a bit of growth in there. And speaking to some buyers agents, we know that, there's still a lot of demand out there for the Brisbane market. So I wouldn't worry about thinking you need to sell that asset. I think there's still a bit of upside. Or putting it differently, I don't think you're going to lose money by hanging on to it for another sort of 3 or even 7 years in that range. But I think leading into the Olympics could be the best time to divest of that asset if you were of a mind to do so. Of course, if that's considered a surplus asset and you had beneficiaries, children to leave that money to, or whoever it is, the way you could think about that is you could put a testamentary trust in your will. The property would then move into that testamentary trust, and that testamentary trust could then distribute that capital gain to multiple individuals, including any grandchildren you might have at that time. So that could be a nice way of sort of passing on that intergenerational wealth. Of course, you might like to go and spend that money as well. So maybe it's a case of selling their property and spending it yourselves, but I just thought I'd throw that in there. But thanks so much for your question, Graham and Helen, and good luck with it all. Okay, next question is from Amelie. Amelie writes, actually, I'll just summarise. Amelie's got an apartment in Brisbane, 1-bedroom apartment in Brisbane in Newstead, no longer earning income and 10 years away from accessing super, and asking whether she should sell the apartment and perhaps put the money into super, or potentially go and buy another property, I think. Put the money in an offset. So Amelie must have other property assets. Amelie, I don't know. I don't know what the answer to the question is because I don't really know your full situation. I mean, Amelie said she's only got 100,000 into super, but I don't know what your other assets are, and your cash flow position and so forth. I mean, if you need to sell it because you're not working anymore and you can't access super anymore, well, the decision's made for you. But let's assume it's a discretionary decision. So you've got access to other monies or income to fund living expenses over the next 10 years, whether you sold the Newstead apartment or not. I think just as a general observation, the Brisbane apartment market went through, say, for the last 3 years, the previous decade or decade and a bit were pretty terrible. There was a lot of supply, new apartment stock being sold to overseas buyers and interstate buyers quite heavily. And so what happened is, people would pay $650 for an apartment. Those apartments were worth, say, $500 to $550 for most of that time and have only just started to recover. So if we think about 3 years ago, that apartment probably would have been worth $500, and today it's probably worth $650. So that market has started to move. And there's just not a lot of supply in terms of apartments coming online. But that market has only started to move over the last 2 to 3 years. And whereas the house market started to move around 2018. So, that's been going about 7 years now. So I don't think it's, the same positive sentiment around Olympics. One bedroom, I wouldn't buy a one bedroom apartment today, not post-COVID, just because people want the flexibility to work from home and so forth. So that's not great. But if you don't need to sell this property, I think you've got somewhere between now and 2032 to divest of it. You don't necessarily want to wait for the absolute peak of the market, or for the full growth cycle to finish. So you can't always time these things perfectly, but I would hang on to it if you could and sell it in a few years' time, maybe 5 years' time. I think you'll be well rewarded for that. Of course, I don't know the property and the exact, property address and type and all those sorts of things. So, of course, there's always going to be idiosyncrasies or additional considerations that, I can't take into account. But it's probably wise speaking to a buyer's agent in Brisbane and having a chat to them and seeing what they think. Any decent buyer's agent that will come across a property that if they think, no, you shouldn't sell that, they'll be honest with you. A buyer's agent that's just after a transaction will probably tell you to sell it and then buy something else just to generate some business. So, of course, deal with someone that's reputable. Probably best to find them via referral. Okay, next question is from a listener that wants to remain anonymous. In essence, 34, based in Sydney, earning 150 grand a year. Household expenses are $110,000 a year because got two very young children, 2 and 4, and wife isn't working, and they're renting for $900 a week, which they're quite happy to do given the flexibility and so forth. They've invested, or they have 3 investment properties. Our total net worth is 1.35 at the moment. Their goal is to reach 2 million net worth, so net of home, I would imagine, and be financially free by age 40. So they've got 3 investment properties, none of which are investment grade, but they've got about $970,000 of equity in those properties. And their plan is to sell the 3 properties over the next 2 years and put it all into ETFs and just simplify the portfolio, reduce debt, and focus on passive income. And the decision they're weighing up is whether to do that, go down the ETF route, or whether to buy an investment property in Melbourne. The listener agrees that the market looks undervalued and could provide some solid growth over the next period of time, even though it would be, taking on more of an active approach and more debt. Their purchasing capacity is about $1.3 million. So this listener's asked me, what would I do if I was in their shoes? And it's a great question, right? When I meet new prospective clients, that's always my starting point. I've always put myself in their shoes and think about what would I do, and therefore, do they need my help in order to do that? What would I do? Look, if that's your goal, I would definitely go and buy the best quality property that I could buy in Melbourne. I'd buy something mostly for land value, again, investment grade location, mostly land value, something that I could always make improvements to. Maybe I'd be happy. I wouldn't necessarily want to make improvements straight away, although you can't necessarily be too pick and choosy about it. It's about buying the right asset. But the perfect scenario would be I buy something that's in tenantable order that I can make improvements to. So kitchen, bathroom, flooring, window furnishings, paint throughout, those sort of cosmetic improvements, nothing more substantial, too more substantial than that. And that way, I've got 2 ways that I'm going to build equity. It's just the general rise in market conditions, underlying land value and so forth, plus then a more active approach. And the more active approach would kick in if I wanted to interrupt that investment strategy. So if for whatever reason, change in circumstances, I need to sell that property in 5 years' time, well, I can do the cosmetic improvements and sell it and hopefully increase the amount of return that I get. Alternatively, I've always got that up my sleeve down the track to improve its income profile and get some more tax deductions in terms of depreciation, or I do it before I sell. But at least I've got it up my sleeve in a way of improving the overall returns. And I think together with the tax benefits, plus the gearing, plus the fact that you're buying into a market that's had no real growth for 10 years and that sentiment's been negative for quite some time, but the market is starting to move, I think, I'd have a high level of confidence the returns are going to be good. And I will remind you, I did episode 303 back in May 24. And I said the Melbourne property market will deliver the strongest growth in dollar value over the next decade. And I certainly stand by that prediction, I guess, that I made about a little bit over a year ago. And so it's looking like it, well, at this stage, playing out okay. Versus the ETF strategy, it lacks the gearing. Well, you can have internally geared ETFs, so that could be a solution to that problem. So we can let's just put that aside. And then the other thing, though, is okay, great. I'm embarking on a ETF heavy strategy when markets are all-time highs. Now, again, you can navigate that. You can go, well, okay, there's certain parts of the market that look more overcooked than others, and there's certain parts of the market that look attractive. But then it's going to come down to asset allocation and portfolio management, and whether you've got not only the knowledge but also the experience to implement that in a way that's going to harness those returns is a challenge, right? And that's I'm not saying that the share market, there's going to be parts of the share market that are going to perform well over the next decade, and there's going to be parts that won't. And I think the general market, if you look at the general global index, it probably won't, because there's too much market cap indexing in the S&P 500. So then the question is, will you be able to pick those areas and get access to those areas in a way that's accurate and timely and cost effective? And I think that's going to be the big challenge with that strategy. So for those reasons, it's a Melbourne property. Okay, I think that's enough for today. Tomorrow, talking about tax reform. Maybe not an exciting topic, but I think it's something that we all need to consider when we're probably going to be debating it over the next period of time. And until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.